begin to record. Hello, Zia, can you hear me? Yes, good. Yeah, we will wait for 1 minute, yeah, for the latecomers, and then we will begin. Yeah, but the content is still the same, yeah, from Tuesday. Yeah, have you attended Tuesday one? Or yeah, you just want to maybe hear it again? No problem. Welcome. Yeah. Okay. Yeah, we will begin in 1 minute.
Charles is their nearest royal neighbour, but he can't just drop round for a cup of tea. He stays 8 miles away. In 2002, after the Queen Mother's death, he inherited the estate.
Yeah, I just prepared it. I haven't begun, don't worry.
Dark Hall. And when in Scotland, the Prince of Wales and...
Okay, so I will share my screen. Okay, hello, Boom. Yeah, we will start it now. Okay, let me share my screen. Okay. I will only share the slide. Okay, let's begin. Yeah, maybe the others, they will get up, yeah, a little bit late and they will join us later. Okay, no problem. So, yeah, today we will start a new unit. Yeah, manage budget and financial plans. Yeah, section 1. The first session is about the introduction and review of financial management concept. Yeah, so hooray, we will start accounting and finance now. Yeah, but we will relate them. Yeah. To marketing communication, yeah. So only like the basics of financial management. Those are very important, yeah, for our business and also marketing communication and also for our daily life, right? So, so how well do you manage your financial responsibility at work? Yeah, as a marketing communication manager, we also will involve some responsibility regarding finance. So we need to know some of it. And the purpose of presentation 1, this presentation will introduce you to the concept of the what this unit is about, how the training will be conducted, and your role related to finance when you are a marketing communication officer. And the program objective, by the end of the program, you will be able to access and utilize budget and financial plans for the work team. So it's about understand, access and utilize budget and financial plans, and consult with appropriate personnel and team members to ensure budget and financial plans are achievable, accurate, and comprehensive. So for the objectives of the program, by the end of the program, you will be able to demonstrate the ability to communicate effectively with the team members, develop written report indicating broad knowledge of managing budget and managing financial resources in the organization. So still, communication, but about the finance, financial communication and the budget. And we'll also be able to demonstrate the ability to utilize financial record keeping software, demonstrate the knowledge of organizational procedures and systems for managing budget and financial plans. So you can begin to utilize financial record keeping software. And the objective of this program is to complete contingency plans, which means if something happened, like some risk, we will have the second, the backup plan. So it's called contingency plan to address potential risk, to the achievement of planned budget and financial plan outcomes. Identify variables, to desired financial outcomes in a timely manner. So review and make recommendations for the improvement of our financial process. And for this session, section 1, at the end of this session, you will be able to identify and apply management accounting principles and techniques to financial planning. From standards accounting practice, cash and accrual accounting, management accounting, and cost accounting. So those are basic concepts. We will only need to understand the basic context, for this presentation. And identify types of budget, identify cost center allocations, to just get familiar with those concepts. So standard accounting practice, so it's about debt and credit. And the application of the accounting cycle, the use of journals and ledgers, like if you are a bookkeeper, the entry level of accountant, like the book, you keep record of the accounts, etc. Which specifically debt and credit, they are equal, hopefully they are equal. And the use of double entry keeping, double entry bookkeeping is you have two entries, debt and credit. One example is like this, double entry bookkeeping, in accounting is a system of bookkeeping where every entry to an account requires a corresponding opposite entry to a different account. The double entry account has two equal and corresponding set known as debt and credit. So at the end, those two lines, they should be equal. Those two or variables should be equal. The double entry has two equal and corresponding sets known as debt and credit. So the left hand set is debt, the right hand set is credit. After you have made many lines, the debt, the expense, and income should be equal. And you just make two entries. But now because we haven't finished this record. So for the daily life, you just put the number here, the money, how much debt, how much credit. Make sure, at the end they are equal. But sometimes, because it takes time, to make sure, to make them equal. So it's called double entry bookkeeping, like this. This is the standard accounting, double entry bookkeeping, like this one. So debt equal to the credit, double entry, which means debt and credit. Double means include debt and credit. Always say expense and income. And the use of accounting groups, asset, including receivables and inventories. Those are assets. Liabilities, like your debt. Capital or owner's equity. Your capital. And the revenue and the expense. You can include them in the double entry bookkeeping as well. So this was called bookkeeping. You just record them. That is the entry level of accounting. Bookkeeping or a bookkeeper. Sometimes if you are intern, just study accounting. You can find a job. Of a bookkeeper. And the practice of making year-end closing entries for the preparation of a financial statement. Those are all standard accounting practice. Which make sure that equals to credit. And the use of those like revenue, expense, asset, liability, capital, etc. These are all standard accounting practice. That is the first basic concept. And next two basic concepts for accounting and finance, cash and accrual method. So there are two approaches that a business in Australia can adopt. When recording transactions, producing financial report, and reporting to the Australian Tax Office. These methods are called cash accounting and accrual accounting. So cash accounting only recognize, record, and process a financial transaction when cash is actually received or paid. Yeah, so if you receive the cash, yeah, you can record it. So it's called cash accounting. While accrual accounting, yeah, recognize, records, and processes the financial transaction, yeah, when the transaction usually occurred, regardless of when it to be paid. Yeah, if you run a business, you might know what I'm talking about. Sometimes they didn't pay you, like when you send them the product, they will maybe pay you later. Yeah, they own you. Yeah. And that is the real life, right? But we also need to record them. Yeah, even like yourself, yeah. Sometimes when you buy a certain product, you use your credit card. Yeah, you didn't pay them in cash like instantly, but after a few days, right? Yeah, and all they will deduct from your bank. Yeah, a few days later. So, but when it happened, yeah, when the transaction actually occurred, you need to record it. Yeah, but maybe, yeah, after 1 day, 3 days, yeah, that is kind of for private, like a transaction. But if for a business, yeah, it might take longer, 1 month, even half a year, yeah. And you also need to, record it, right? So it's called accrual accounting. So 2 types of cash and accrual method, but they all have a different benefit. So accrual accounting is an accounting process designed to more accurately reflect the nature of business financial positions and performance. Yeah, because we want it to be accurately recorded. And after centuries of accounting practice, accrual accounting has become the standard of reporting. So now we kind of mostly use accrual accounting, and adopting the accrual accounting method align with Australian accounting standard board AASB standard, and with the practice of larger corporations. So other benefits for adopting the accrual accounting method include more accurately reporting the profit of a business for a given period, and providing a better method for planning expenses, as well as preparing monthly and yearly budget, and provides the true value of the business. We want to know the true value. Because normally they will pay you. They will pay you later. So you also need to record it. Although you didn't get the cash instantly. So there are 2 types. And management accounting, there are another types of accounting: financial accounting and management accounting. So now let's first explain management accounting. Always say managerial accounting or management accounting deals with the information that is not made public and is used for internal marketing communication only. While financial accounting, like this graph, as you can see, accounting include financial accounting and management accounting. Why we study finance? Because it goes to public. So financial accounting is focused on producing a limited set of specific prescribed financial statement in accordance with general accepted accounting principles. So the financial statement financial accounting. So it's easy to understand, right? And the central output from financial accounting are audited by someone else, by the other organization. Financial statements such as balance sheet and income statement that provides a scorecard by which a company's overall past performance can be judged by outsiders. So financial accounting is by external users set to report. Now we all know that some students they study finance, they study accounting, or they study management. Now you kind of know what are the difference between those 3 concepts, right? If they study accounting, they can work for the internal organization, or they can work for some external like financial companies, or they work with the public. Like if a listed company they go to the stock market, they should have many annual report and the presentation to the investors. Those are the jobs for the financial stuff. While management is about internal management, right? Like your manager, the employees, management. And the accounting regarding them, it's called managerial accounting or management accounting. So it helps, management achieve the goals and objectives of the organization with an emphasis on the management, analysis, communication, and the control of financial and non-financial information. And yeah, external for the financial accounting, yeah, external users that report, yeah, I reported, yeah, to the government agencies, investors, as I mentioned, yeah, the general public, obviously creditors and loan funders, trade associations. So you need to maybe make a report of your financial status, of your financial statement, yeah, to the outsiders, yeah, to the externals. While internal, yeah, users, customer report, directors and CEO, line managers, store employees is internal. So managerial, yeah, accounting or management accounting. So managerial accounting, yeah, are far more detailed than the financial accounting and can cover performance and activity by department, products, customer, and employees. Yeah, because it deals with internal, it's more specific, right? Not like a financial accounting, like some students study finance, yeah, it's only for public, yeah. And we all know that, yeah, in Australia, yeah, a lot of students study accounting because they can find a job, yeah, they can apply for the permanent residency, right? They are sponsored by the state. Yeah, because accounting is kind of very useful in the business, yeah, but not finance student. Yeah, maybe the Australian, they feel, you're only part of it, we want more. Yeah, that is what I'm thinking. Maybe not, yeah, their intention, but yeah, that is our, yeah, conclusion. Maybe it's but because that. Now we know, yeah, the basics about accounting, finance, and management. Okay, let's continue. And it's an accounting system that helps management achieving, yeah, the managerial accounting, yeah, is an accounting system that helps management achieve the goals and objectives of the organization with an emphasis on the management, yeah, analysis, communication, and the control of, yeah, financial and non-financial information. Okay, so are you clear? Then, yeah, let's go to the next, yeah, management accounting, yeah, the planning and the controlling of it. So yeah, planning, yeah, involves formulating, yeah, the company's firm's, yeah, objectives and include, yeah, details description of the steps, yeah, needed to meet these, yeah, objectives. Planning involves a customer report derived from, yeah, information in financial statement and activities such as, yeah, finance and management accounting also have some financial statement. So they are kind of like lapped, yeah, with each other. We cannot like separate them, yeah, totally. Yeah, but kind of accounting is kind of the umbrella term, yeah, it's broader, right? Yeah, but it also involves, yeah, financial, no matter, yeah, financial accounting or management accounting. And the accounting, yeah, include, yeah, the activities, yeah, such as here you can have a look, yeah, cash flow, yeah, projections. Yeah, like you predict, yeah, the future cash flow, which means that, and long-term budget, yeah, and the plans, and the operational plans, yeah, like how you operate, yeah, short-term budget and the plans, yeah, financial projection, yeah, like you predict the future finance, like a status, and yeah, setting target and key performance indicators. Yeah, please remember this key performance indicator. Is very important. You might always hear that from like the televisions, TV dramas, TV series, even reality show. Yeah, it always mentioned by people. Yeah, key KPI means key performance indicator. Yeah, so who can give me an example? What can be the KPI? Yeah, KPI, key performance, yeah, indicator for the business performance. Yeah, anything. What do you think? Do you remember what is key KPI? I already tell you the answer. It's called key performance indicator. Yeah, some people, yeah, in business always mentioned KPI. It means key performance indicator. So for the business performance, what can be an example, yeah, of KPI? How about Bun Li? Are you with us now? Hello. Hello. Maybe, yeah. Yeah, his microphone doesn't work. Okay. How about Zhang? Do you know what KPI is? Zhang, have you attended a Tuesday's class? Hello, are you with us, Zhang? Not yet? No problem. Yeah, Zhang seems is having breakfast, no problem. How about Xiao? Yes. Can you give us an example of KPI? What can be a KPI, like a key performance indicator? Do you remember?
I think KPI is a company to use data to evaluate their success.
Yes.
The reaching
correct.
targets.
Yes. So what can be a KPI? Like what can be an example of the indicator, like key performance indicator?
Miss Dashi?
Yes. Hi, John. Do you know? Yeah.
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 When I was working in a call center before, part of our KPI is our statistics, like our customer satisfaction.
Yes.
Yeah. And then our average handling time.
Yes.
First score resolution. So those are the things that were considered to be part of our KPI. It's like a metrics that we need to achieve.
Yes. And yeah, some examples can be like your sales. Yeah, even your sales. It's also yes. And production, like how much you can produce your certain product. And all income, like how much your employee earn, our expenditure, like how much you spend, all some other things, like June mentioned, even customer satisfaction, like numbers, statistics of that. Yes, many things can be the key performance indicator. They are all called KPI, correct? Yes, good job, June. Yeah, so June, like where do you work? Yeah, like you mentioned, for your KPI, like is restaurant or what is the like a company or place? Hello, John. Hello. Yeah. Sometimes it's kind of the connection is not very good, right? Yeah, but I think you all know. Yeah, you all understand. Yeah, the KPI. The example, I'm not sure whether you can see it clearly. I also put it here. Yeah, production, sales, income, and expenditure. Yeah, I already uploaded the slide. You can also have a look. Yeah, and many others. Yeah, the key performance indicator. Yeah, mostly they are production, sales, income, expenditure, and etc. Yeah. What is your key performance indicator? Then that is a key performance indicator. Yeah, how much you sell, of course. That is the most important independent performance indicator, right? Or how much you can produce a product, like maybe only one per day. The performance is not very good, right? But you can produce a lot. Yeah, so production and income, how much you earn. Yeah, of course, it's the key performance indicator. And the expenditure, how much you spend. Yeah, if you spend more than you earn, that is a problem. So we need to care about those. So that is our KPI. Okay, understand it? Yeah, we always use that. Yeah, even maybe in your interviews, in your everyday business life. Yeah, even when you watch a TV drama, it always mentioned that. Yeah, so you need to know that. Okay, good job. And control, the control of management accounting involves the continuous assessment of accrual performance against a budget or standard, or target. So it's the continuous assessment of actual performance. Yeah, so that is the control. Then you can control your standard. You control your KPI and the target because you need to access the performance, right? So importantly, it involves taking corrective action, through following or forming contingency plans. To make financial plans on track, control may also include revising plans or target. In other words, planning and control may influence each other in a process of continuous and reciprocal improvement. So for the principles of cost accounting, so about accounting of the cost, right? Accounting for cost as opposed to outlay. So first you need to understand what outlay is. Do you know? Who knows? You can type it or unmute yourself. So If you don't know, I will explain. Outlay is the amount of money that you have to spend in order to buy something or start a project. So that means the money you paid out, right? Yeah, so are you clear? So accounting for cost as opposed to something you like some money you spend. So cost versus outlay. Yeah, cost as opposed to outlay. So you need to record them. That is the accounting for that. Yeah, so please remember this term. Yeah, outlay. Yeah, it just means the expense. Yeah, something you spent to start a project. Yeah, like something you need to spend to buy something. So accounting for cost as opposed to outlay. And the outlay cost is the cost incurred in order to execute your strategy or acquire in an asset. So outlay costs are easy to recognize and measure, because they have actually been paid to outside vendors as opposed to opportunity costs, which are not actually incurred and paid to outside the company. Next, accounting for hidden costs and externalities. Just some hidden cost, not direct cost, but hidden cost. And accounting for direct overheads, always say indirect cost. This is the terminology I want to introduce, and it always mentioned in our textbook and maybe in your daily life of your business. Overheads is the same meaning of indirect cost. Overheads. Please remember it. Direct overheads or indirect cost. And so it means direct cost and indirect cost. And accounting for past and future outlays. Do you still remember what outlays is? The money you spent. And accounting for costs according to the life cycle of the product. So I will explain one by one, so don't worry if you're not very familiar with it. So first, life cycle of the product. Do you still remember? We studied that before. In the certificate. Accounting for costs according to the life cycle product. If you have a product, it has a life cycle. So from the introduction, you only sell a little bit, right? And then the growth product of your life product. Like even when I was studying in China for my undergrad, we also studied this. Even my major is public relations. Because it's very important for marketing. It's an important concept. And maturity, like at the in the maturity, at the maturity stage of your product, you will sell the maximum. You sell a lot. Everyone knows your product. And the decline, it's like a person. So it's called life cycle product. And so we will talk about some basic like concept again. First, fixed cost. Some costs are fixed. Fixed costs are those costs you need to spend to maintain your business or product sales. For example, the rent is fixed. But those do not change in line with changes in your sales volume or business activity. Like no matter how much you sell, how much product you sell, you need to pay the rent, and the rent is the same, right? So it's called fixed cost. So it's like this, total fixed cost, because the cost is the same. The rent is always maybe $300 or much more. No matter how much product you sell. But and in another graph, you can have a look. Fixed cost per unit. If you produce more product, of course, your kind of a fixed cost per unit, like your rent per product is decreasing, right? It means like if you produce more product, like your cost of the rent, like per unit is less, right? You get that? So rent is good illustration of a fixed cost. Regardless of how much you sell, the rent is still going to be the same. Other fixed costs could include equipment rental or lease arrangement, insurance, interest on debt, plant and equipment expense, utilities, business license, and salaries of permanent, full-time workers. So below show total cost do not change with increased volume of production. Yet fixed cost per unit reduced, the more volume is produced. Okay, so you all understand fixed cost. And opposed to fixed cost, we will also study variable cost, which means the cost will be variable, right? So variable cost, are those costs that do vary in line with, and usually in direct, proportion to changes in sales of a business activity. So usually the largest and the most common variable cost is the cost of buying or manufacturing goods are sold. The cost is often referred to as the cost of goods sold, or we say COGS. And other variable costs might include packaging and labor directly involved in the company's manufacturing or sales process. So vehicle fuel and the salesperson telephone cost. So as the chart below shows, variable costs will increase in line with volume, yet that the variable cost per unit will remain the same. So let's have a look at this, like a graph. If for example, if we use one variable cost, which cost is vary in line with the direct proportion. Maybe let me choose the cost of buying the goods are sold, like the cost of your raw material, right? You need to spend maybe $10, when you make one product, right? So the total variable cost is like this. If you produce more, you will have more cost, right? Because you have the raw material. Like the cost of buying the manufacturer. Like you need to first buy your material, and then you can make maybe you need to buy the clothes, and then you can make maybe the cloth, and then you can make like a dress, right? So that cost is varied. If you buy more and then you produce more. So it's like this. And the variable cost per unit, then it's the same. Because for every unit, the cost might be the same. If the same product, if you have the same product, like if a can of the maybe the fruit, the cost is like those like the cost of the labor, you will kind of put the same time of them, right? So variable cost per unit is the same. Okay. Hello, Junyu. So now, we will have 10 minutes, break, and at 10:15, please come back, and we will continue. We still have 10 slides. And after, the presentation one, we will have 10 minutes slide, and you come back at 10:15, and we will continue to study the next few slides. And for this afternoon, I will help you to go through the section 1 of our textbook. So that is today's schedule. And then it's next week. Either Tuesday or Friday. You can choose which one you want to attend. But the content are the same. Like I will repeat Friday's class to Tuesday's class. But if you like you can of course you can attend both, but then you just hear the same content. Only one day attendance is required. You only need to attend one day every week. That is enough for you. Okay, so any questions? If no, 10 minutes break. You can have some breakfast and come back at 10:15. I will mute myself, and we will continue at 10:15. Hello everyone, are you back? We will begin in 1 minute. The break is finished. We will start it now. Maybe you can reply me. I'm using the microphone now. Can you hear me clearly? Are you back? Maybe just type something. Yes. You are back. Hello, so I might begin. Yeah, is that okay? Are you still with us for everyone? Yeah, maybe you can type a yes to show you already come back. Okay, so I might begin anyway. So yeah, at the end of the first session of this morning, I talk about the variable cost and the fixed cost. Yeah, so now I will explain another two basic concepts in accounting and finance. Yeah, direct cost and indirect cost. Yeah, direct cost. Yeah, are those costs incurred by a firm which can be directly attributed to the unit of production, like raw material, etc. Right? Yeah, direct cost. So direct cost, as I already explained, can also be the variable cost, right? Like if you make sure direct cost is a raw material, it can be a variable cost. And indirect cost are those referred to as overhead. So a terminology, please remember I already explained overhead. Is another name for indirect cost. So overhead are those costs incurred by the firm, but which cannot be attributed directly to a unit of production. So one example of overhead is rent. So indirect cost can also be fixed cost, right? It depends whether it's fixed or not. So like rent is at the same time indirect cost and fixed cost. So it's incurred by the firm, but which cannot be attributed directly to a unit of production. So I can show you a graph, like direct cost, like this. Expense that directly go into producing goods or providing services. Direct labor, direct materials, manufacturing supplies, or indirect cost. The general business expense that keep you operating, like a rent, utilities, general business. Where direct costs are expenses that directly go to producing goods or providing service, like I mentioned just now. And like some example, like direct costs, they might also be fixed costs. Indirect costs, might be fixed costs. Yes. Direct costs might be a variable cost, like rent, the direct labor per unit, right? Indirect costs might be rent, like fixed cost. Rent is fixed, utilities, and sometimes it's fixed, sometimes it's varied, So it has some relationship, with each other. And the overhead cost, indirect material cost, indirect labor cost, and the indirect expenses cost. So overhead cost, I always say here, this. Indirect cost has also some sub cost, like direct material cost, indirect labor cost, or indirect expense. And the overhead, again, just explain again, refers to ongoing business expense, not directly attributed to creating a product or service. It's important for budgeting purpose, but also for determining how much a company must charge for its product or service to make profit. And overhead costs like rent, utilities, office supplies, marketing, and office communications. Well, if they are not overhead costs, they might be direct costs like production vehicle insurance, job materials, raw materials, etc. Payroll tax on the production workers. And activity-based costing model. So activity-based costing model identified production costs based on all the activities required to produce a product or service. So this model considers many so-called overhead or indirect costs as direct cost of production, because only record the overhead cost, obviously indirect cost.
And activities such as after-sales customer service may also be considered as part of the product cost. So overhead expense are all costs on the income statement, except for direct labor, direct materials, and the direct expense. And overhead expenses include accounting fees, advertising, insurance. So like for our major marketing communication, it's overhead cost, right? Yeah, it's not directly to generate your product to earn the profit, but overhead. But it might be legal profit, like interest, legal fees, labor burden, rent, repairs, supplies, taxes, telephone bills, travel expenditures, and utilities. So are you familiar with overhead costs? And before I explain further, I want to mention a concept, important concept, break even. Are you familiar with this? The break even. Who can tell me what does break even mean? Are you there? How about Theo? Theo, are you there? Are you still with us? Or maybe let me explain. How about Boone? What is break even? Hello, hello, hello. So maybe let me explain. Which means the profit equals 0. So it's suppose you wanted to calculate the number of sales required to reach break even. Profit would equal 0. So it didn't earn anything. The profit equals to cost, so equals to 0. And yes. Hello. Okay, no problem. Let's continue. And the cost accounting, concept and models. Manufacturer cost concepts, include the prime cost, production cost, conversion cost, marginal cost model, activity cost model. Please refer to page 20 and 21, the student workbook. It gives you explanation of every cost. We will review that this afternoon together as well. Sorry, maybe I still. Okay. Maybe I also show this slide. That is kind of easy to function. Okay. So maybe let me explain a little bit. For every concept. Of the cost. So prime cost is composed of direct material costs and direct labor costs. So they are direct prime cost. We will study a little bit again in afternoon, so don't worry if you are still not sure. And the production cost is composed of a prime cost and the indirect cost. So it includes the prime cost and indirect cost. And the conversion cost, the cost required to convert a product from raw material into a product. So it's composed of indirect cost and direct labor cost. So that's called conversion cost. You convert your product into raw material into product, what do you need? So that's called conversion cost. And marginal cost model, or we call it cost volume profit, CVP, involves analysis of relationship between production cost, sales volume, and profit. So using CVP analysis, you can calculate the break-even point. The break-even point. I already explained. Do you still remember what that break-even means? Which means you didn't earn anything. And the volume of sales required to earn a particular profit. So the budget, the budget classifications. So what does budget mean? You might already know that before you study. It's here, on the slide. The specific forecast of anticipated results of a business of a specific period, like your prediction of how much you can pay. You need to pay. What is your budget? You will always be asked about that question. When you buy anything. And the budget can be grouped into certain categories, like a financial budget. We already explained financial accounting, right? So you kind of get a clue of what finance is, right? So financial status of the organization, yeah, cash flow budget, profit budget, etc. They are called financial budget. Yeah, if you study finance, you will do those, yeah, financial budget. And operational, yeah, budget, which, yeah, are prepared in support, yeah, of organization's revenue target and may include their sales budget, yeah, production budget, raw material budget, and the labor budget. So those are what you need, yeah, when you operate. And the sales budget are usually expressed, yeah, in units, like X, yeah, selling price. For example, if a product A is expected to sell 100 units at $15, then the sales expected would be how much? $1,100. Yeah, so the budget is that. And the time frame, yeah, budget from short term, medium, and long term. Of course, easy to understand. So for short term budget, yeah, these management, yeah, expectations in relation to the current, yeah, business operations. They cover a period of a week, month, or quarter, yeah, up to a full year. So short term budget from a week to a full year, yeah, just remember. And intermediate budget, always say medium budget. Yeah, these are usually required, yeah, for plans involving entry into new market, new product release, and equipment replaced in the near future. They normally cover a period from 1 to 3 years. Well, long-term budget, yeah, next to 10 years, so 3 to 10 years. So these are the strategy budget, yeah, set by the senior management as a vision for the, yeah, position of the firm aiming for the next 3 to 10 years. So you need to make those budgets if you are the accountant or financial, yeah, manager of your company. Then we will, yeah, talk about and study, yeah, cost centers. Yeah, this is an example of cost centers. So from margin, a master budget to cost centers. So in order to break up a firm's master budget, so you kind of have a big budget. How much is the budget? So that is called master budget. Into cost centers, you divide it. Yeah, you divide those budgets by location or by some other like categories. Those are called cost centers, because you cannot just say, yeah, I have a master budget. It's too broad, right? So yeah, you can break up a firm's master budget into cost centers. And so when you make the cost center, you need to determine the following. Yeah, first, the basis of the cost center split, like by a location, like this one, like Central Australia, North Australia, South Australia, or by functional type, like different function, and by name or number of the cost centers, and the metrics for each cost center, like customer number, production number. This one is allocating the telephone, sales amount, and the sales unit. The basis for allocating overhead. Do you still remember what does overhead mean? I already explained. Hello, Zhang, do you remember? Hello, Zhang, are you still with us?
Yep.
Yeah,
Which
do
one
you
is that,
remember? Yeah, do you remember what overhead is? Do you still remember? I explained overhead.
No.
It's here. Overhead cost means indirect cost. Yeah, indirect expense.
Okay. All right.
Yeah, you have direct cost like raw material in your company, like, right? But you also have indirect cost like the rent. Yeah, something indirect to your business, but it's also very important. Got it? Just the terminology. Yeah, overhead. Yeah, means indirect cost. Yeah, all overhead cost means, yeah, indirect cost. Okay, then let's continue. Okay, then I will mute John. And yeah, when splitting a master budget into the cost centers, the first aspect to focus is the revenue, yeah, or production details. Yeah, these will help, yeah, to set the direct cost allocations. Yeah, all overhead. Yeah, if you want to allocating the overhead, the indirect cost. Yeah, equally between the cost centers. Yeah, all by different percentage. Like this one, the master budget. Yeah, is here. 1 million, and yeah, different sales have different, yeah, percentage of it, and you will allocate, yeah, the $10,000, yeah, for telephone, and then you have the sub budget, yeah, for this company, for this for the allocation of the telephone, yeah, this one is 10,000, and then yeah, like that. You can read the student workbook. Yeah, I will also explain that in afternoon. And the next step, please read the section 1 and do the learning activities of section 1 of a student book, and read through section 2 if you finish that. Yeah, for this afternoon, I will explain the student workbook section 1, and next week we will study section 2 together. There are 5 sections because this unit is very difficult and long. 5 weeks. We will study this unit together. And so next step, workbook, and begin. If you want, you can begin to read the assessment task, but it might be too difficult for you because we haven't finished started. So normally I recommend you maybe start it after 2 weeks. You can do the assessment. So now you can still finish like your last assessment. You haven't submit them. And begin to read the workbook if you finish that. And for all the assessments from now on, we need the video evidence as I already mentioned, and also for the role plays and the presentations, you can record by yourself or email Gagan. If you only do a presentation, if you want, you can Zoom. Use Zoom to record you. Otherwise, if you don't know how to record it, just email Gagan. And sometimes you need to do a role play with the assessor, right? Then you have to email Gagan. We need some video evidence. If you can speak proper English. If you really can't, then maybe you can leave it for now, but maybe we still ask you to do it later. So if you can finish, just do it perfectly with the video evidence. So now the first part of the assessment 1, not assessment 1 explanation, but presentation 1. Presentation 1 explanation, it has finished. This afternoon we will start the section 1 of student workbook. From 1:30 to 3 to 30. And please read student workbook or do your previous assessment. Until 12, and then you have 1 hour and 30 minutes lunch break. And in the afternoon, we will review the student workbook of section 1 together. And then we have a Q&A until 4 p.m. Okay, sorry, not 4 p.m. Maybe 3:40, something like that, until 4. We give you a little bit more time, from now on. Before we only finish at 3 or 3:30, right? So now we kind of will finish at 3:40 to 4, kind of like that. 45, like that. And put your student name and student ID as a Zoom ID, and then Zoom will record the attendance automatically. Okay, any questions? Maybe I give you more safety. Okay. If no, I will just pause recording and mute myself. If you have any questions, just use the chat function to leave it, and then I will answer you when I have time. Hello, we almost finished this morning's session. Any questions? If no, I will let you go to your lunch break and come back at 1:30. Okay, so no questions. So one last call. No questions. Okay, so see you at 1:30. We will study the student workbook. Section 1. All we call it learner's guide. For this afternoon. And bye for now. See you this afternoon at 1:30. Okay, is that okay? Okay, bye.